Mortgage rates move 0.5%, and it sounds small. Then you plug it into a payment, and it can be the difference between "this works" and "we're waiting." By the end of this video, you'll be able to take any mortgage rate headline and turn it into a rough monthly payment change in under a minute. And you'll know the 3 signals that usually tell you whether quotes are likely to drift lower or pop higher next. Start with the part people actually feel. On a 30-year fixed loan, a 0.5% change in rate is often about $30 to $35 a month for every $100,000 you borrow. That's not a perfect rule, it's a quick translation. So if you're looking at a $400,000 loan, a 0.5% swing is roughly $120 to $140 a month. Over a year, that's about $1,400 to $1,700. For some households, that's groceries. For others, it's the margin that keeps the budget calm. Here's another way to see the same move. If you think in, how much house can I afford? Keep the payment fixed and let the loan amount move. At a $2,400 principal and interest payment, 6% roughly supports about a $400,000 loan. At 6.5%, that same payment supports closer to $380,000. At 5.5%, it's more like $420 plus. That's a swing of about $20,000 in purchasing power from just a 0.5% move. And that's before taxes, insurance, and HOA fees, which are why people feel like the math is lying. If those costs are another $600 a month, your all-in payment could be $3,000, even when the mortgage math says $24. So always be clear which payment you're talking about. Picture someone shopping with a hard ceiling of $2,400 a month for principal and interest. They're not trying to time the market. They're trying to keep the payment from wrecking the rest of the month. Here's the clean mechanism. A mortgage payment is a math machine. It takes a loan amount, an interest rate, and a term. Early on, a big chunk of your payment is interest, so the rate has a direct grip on the monthly number. If you want one back-of-the-napkin method that's usually close enough to make decisions, use the per 100,000 translation. At around 5 to 7% on a 30-year, the payment is roughly $500 and something to $600 and something per month per 100,000 borrowed, and a 0.5% move tends to shift that by roughly $30 something per 100,000. Let's do a simple worked example. Loan amount, $300,000. Rate, 6%. At that neighborhood, the payment is roughly $1,800 a month for principal and interest. Now, move the rate to 6.5%. You're typically adding around $90 to a little over $100 a month on that $300,000. Move it down to 5.5% instead, and you typically save a similar amount. Notice what I did not do. I didn't pretend we can predict next month's exact rate. We're translating what the move means if it happens, so you can plan. Now, the next question is always, okay, but why did rates move at all? Because mortgage rates are not set by one person in a room. They're priced like a product. A very simplified chain looks like this. Investors buy bonds. Mortgage loans get bundled into mortgage-backed securities. Those securities need to offer a return that competes with other safer returns, especially U.S. Treasury bonds. When the return on treasuries rises, mortgage rates usually get pushed up too. When treasury yields fall, mortgage rates often ease, but not always at the same speed. That not always is the part that confuses people. Mortgage rates are not just the 10-year treasury yield plus a fixed number. Lenders also price for risk, competition, and the extra wiggle of mortgage-backed securities. So sometimes the 10-year goes down and mortgage quotes barely budge. Other times, the 10-year is flat and your lender suddenly feels cheaper this week. Let's bring it back to that buyer with the $2,400 payment ceiling. If rates ease by 0.5%, their ceiling buys more house, or it buys the same house with more breathing room. But if home prices respond by moving up, the relief can get eaten. That's the first key translation for your wallet. Rates affect the payment fast. Prices and inventory decide whether that rate relief turns into actual affordability. The counterpoint is worth saying out loud. A lower rate is not automatically better if it comes with higher fees, points, or a tighter approval environment. Sometimes the monthly payment drops, but the cash needed at closing jumps. So you want to look at the full deal, not the headline. Now let's talk options, in a way that lets you locate yourself without being told what to do. The variable that matters most is your timeline. If you're buying in the next 30 to 60 days, the main risk is volatility. Quotes can move while you're shopping, while you're under contract, and even between application and closing if you haven't locked. One common approach is to focus less on guessing the bottom and more on setting a payment you can live with and watching the lock terms. The upside is you reduce the chance of a surprise that breaks your numbers. The downside is you might lock and then see slightly better quotes later. If you're more like 3 to 6 months out, you can treat rate moves as information, not urgency. This is where you can build a watch list and run scenarios. If rates drop 0.5% from where you started, what home price becomes realistic at your payment ceiling? If rates rise 0.25%, what breaks first? The upside is you get calmer decisions because you're not forced into a single quote. The downside is life happens, and you can't guarantee timing. If you're a year out, your biggest lever is usually not the weekly rate print. It's your borrower profile. Credit score range, debt to income, and down payment can change your quote by as much as a headline move, sometimes more. The upside is you can improve the quote you qualify for regardless of market noise. The downside is it takes time, and it's less satisfying than watching a chart. Now, if you already own a home and you're thinking about refinancing, the math is similar, but the decision variables change. It's not just rate down, refinance, it's rate change versus closing costs and how long you expect to stay. A simple way to think about it is break even. If refinancing saves you $200 a month and the costs are $4,000, you're looking at about 20 months to break even. That's rough math, but it's the right question. The upside of using a break-even frame is you stop making emotional decisions. The downside is you still need real quotes because fees vary a lot. Back to our buyer with a $2,400 principal and interest ceiling. The clean move is to build your permission slip numbers before you fall in love with a house. Permission slip number 1 is your maximum all-in housing payment. That's principal and interest, plus property taxes, plus homeowner's insurance, plus HOA if it exists. If you do not know taxes and insurance yet, estimate them and treat the estimate as a safety buffer, not a guess you'll magically beat. Permission slip number 2 is your maximum loan amount at today's rate and at 2 nearby rates. Today, plus a quarter, minus a quarter. If you want a faster safety version, do plus a half and minus a half. This is the part that keeps you from shopping a price when you should be shopping a payment. Here's the quick decision rule that prevents most mistakes. If your payment only works in the best case rate, you're not shopping safely yet. If your payment works at today's rate and still works if rates pop a quarter, you're in a sturdier zone. Now, let's talk about the 3 signals that tend to matter most for mortgage rates and how regular people can watch them without turning into a bond trader. Signal 1 is the 10-year Treasury yield. Where to look? Any finance app, a major finance site, or just search 10-year Treasury yield and open a reputable market quote page. What direction means? If the 10-year is trending down over a few weeks, mortgage rates often have room to drift down too. If it is jumping up quickly, mortgage quotes can reprice higher fast. Typical timing: mortgage quotes can respond within days, sometimes the same week, but not always one for one. Signal 2 is the spread between mortgage rates and the 10-year, basically the extra gap. Where to look? This is harder to see directly, so use a proxy. Watch Freddie Mac's weekly average mortgage rate and compare its direction to the 10-year's direction. What direction means? If the 10-year is falling but Freddie's weekly average barely moves, that gap is staying wide, which can mean lenders are pricing in extra risk or demand is strong. If the 10-year is flat and mortgage averages are drifting down, that gap is tightening, which can show up as better quotes. Typical timing: this tends to move over weeks, not days, because it reflects competition and risk appetite. Signal 3 is your personal quote signal, the only one that is guaranteed to matter to your wallet. Where to look? The loan estimate, specifically the interest rate, the APR, and the total closing costs section. If you're not under contract yet, use a lender's written pre-approval quote sheet or a locked quote, not a vague phone number. What direction means? If your rate is falling, but your APR is not falling much, you might be paying for the lower rate with fees or points. If the rate is steady but closing costs drop, that can be a real improvement. Typical timing: this updates whenever lenders reprice, and it can change during the day on volatile weeks. Treat it as a living number until you lock. Now a quick reality check. A lot of people stare at the national average and assume that is what they'll get. Your quote is a blend of market rates and your profile. That is why a credit score move, a debt payoff that lowers your monthly obligations, or a bigger down payment can change your quote even if the headline stays the same. So, for our buyer with the 2400 ceiling, the best rate strategy may simply be, quote, strategy. Shop at least 2 to 3 lenders. Compare the loan estimates line by line, not just the rate, and ask the same question every time. Are we comparing the same loan type, same term, same points, and same lock period? Now let's do the 2-minute checklist. These are the exact screens and lines that prevent the most expensive confusion. First, your credit reports. Where? Annualcreditreport.com for the official free reports, and your bank or card app for the score trend. What to check, errors, high utilization, and missed payments. If something is wrong, it can cost you more than 0.25% on the rate. Second, your debt-to-income snapshot. Where? Your pay stubs and your recurring debt payments, plus your lender's pre-approval summary. What to check? Your total monthly obligations and how close you are to the lender's limit. If you're near the edge, a rate jump can push the payment over the line even if you can afford it. Third, the loan estimate itself. Where? The PDF called Loan Estimate. What to check? The interest rate, the APR, loan costs, and other costs. If a lower rate comes with big points, you're paying up front for a smaller monthly number. Fourth, the cash to close number. Where? The loan estimate and your lender's cash to close breakdown. What to check? Whether you can comfortably pay it and still keep an emergency buffer. A great rate is not great if it drains your safety net. Fifth, the tax and insurance reality. Where? The listing, the county tax assessor site, and an insurance quote. What to check? If taxes are reassessed after purchase in your area, and whether insurance quotes are rising. This is where the payment change surprises happen. If you remember one takeaway, make it this. Mortgage headlines are useful, but only after you translate them into your payment and your cash to close. A 0.5% move is not abstract. It is a monthly number you can estimate, and it has a predictable chain that you can watch. For our buyer with the 2400 ceiling, the goal is not to win the perfect rate. It's to set a payment that keeps the rest of life stable, run the 0.25% stress test, and compare real quotes like a pro. If you want, in the next video we can do the same translation for auto loans and credit cards, because the repricing rules and the timing are different, but the wallet math works the same way. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns, and leave a comment with the next topic you want covered or the one part of today's video you want explained even simpler.